Hello, fellow bankers. Dr. E here. Let's see if we're doing this. Yeah, there we are. There you are. I see you there. I see you there. I see you over there. Hey, open your eyes. I haven't even started lecturing yet. Don't fall asleep yet. All right. Hey, you in the back, how about that snack you're eating? You want to bring some of those cookies up here? All right. Did you make enough for the class? All right. So, Chapter 17, Commercial Banking. Slides 1 through 9. Okay, this is about lending to business firms and how banks go about pricing business loans. So, business loans are typically called commercial and industrial C&I loans. Okay, important to get the lingo down. So for U.S. FDIC insured banks, commercial banks, close to 20% of their loan portfolio across the country on average is classified as business loans or commercial and industrial loans, and this does not include commercial real estate. This is just for private business. Does not also include loans that one lending institution makes to another lending institution. So 20% of the loan portfolio goes to help keep business going. All right. Commercial and industrial loans represent the earliest form of lending that banks carried out. This was really how banking got started and grew. And if any of you went to Huff, you learned about the Medicis and the bank that they owned in Florence, and that the bank and the personal wealth of that Medici family really financed the Renaissance period. All right. So primary borrowers back in the day included people and companies that owned ships and that mined and that manufactured, okay, and that bought and developed buildings for people to rent. All right, new competitors in the commercial and industrial lending field include finance companies, lots of finance companies out there. Okay, they're not banks, but they're finance companies. Okay, insurance companies and savings and loans. And we've talked about this before. All the competition that's flooded into the finance business. Why? Because the margins are good. Okay, anytime you have good profit margins, you're going to attract competition. All right. So, and once you start attracting competition, intense competition does have a squeezing effect, the effect of driving margins down as companies become better at managing themselves. They can charge a lower price and still make a decent margin, and they force the entire industry to either operate more efficiently or go out of business because they squeeze margins. All right. So let's look at short-term loans. The most popular way to borrow money is through a revolving line of credit. A revolving line of credit. This allows a customer to borrow up to a specified limit, and we looked at this, we call it off-balance sheet financing, when a company can borrow up to a certain amount, okay, and but they don't necessarily borrow all that money. Okay, you borrow what you need, then you repay a portion of the borrowing, the portion of the principal, and then you go back in and borrow more. In other words, what you're doing with a revolving line of credit is you're trying to smooth out the volatility of your cash flow. So if all of your money comes in at the beginning of the month, toward the end of the month you might start running out of money, and you borrow to get you over that last week of the month, and then in that first week of the month money comes in, and there you go. Over time, hopefully, you earn enough profit and retain that profit so that you don't have to have a line of credit. All right? So lenders do normally charge a commitment fee. So the customer who wants a line of credit pays a commitment fee, and the fee is typically charged on the unused portion of the credit line. So you pay a fee on the unused portion, and you pay interest on the amount of money that you draw. However, sometimes the fee is charged on all of the funds that are made available. So this is a negotiating situation with the bank. How will the commitment fee be charged? The loan term is short, typically a few days to 1 year. So when you borrow money on a line of credit, you have a relatively short period of time to pay that money back, unless you haven't drawn all of the money. Once you reach the limit, then you're going to have to pay it all back. But you can borrow for a period of time, pay it back when the cash flow comes in, and then borrow again. So it gives you a lot of flexibility. You don't have to continually talk with the banker about taking a loan out. All right, so lines of credit, business lines of credit are typically secured by assets, and the assets typically are accounts receivable or inventory. So this is the collateral that banks have in the event a company defaults on its line of credit. These revolving lines of credit typically have an adjustable rate or floating interest rate. Okay, and so if as interest rates go up and down, then the interest rate on your loan will move as well. And often the bank will ask you to keep some of the cash in a cash type savings account or checking account as additional collateral. So how is the bank protected from a default? Some assets and some compensating balances. Compensating balances, keeping cash in a very liquid account at the bank. All right. Another type of loan that banks typically make to businesses, interim construction financing. Okay? These are relatively short-term loans that are used to support the construction of commercial real estate, which is homes, apartments, office buildings, and shopping centers. So anytime you want to develop a commercial property, there are two loans that you have to take out. The first is the construction loan, and the second is the permanent financing. Okay? They are different kinds of loans with different terms, often made by different banks. Okay? But I just want you to be aware that you don't take permanent financing out at the beginning of a development project. Okay? Once construction is complete, then you take out a term loan, or what we call permanent financing, that is usually very long term. Now, what typically happens is you'll have a period, the interest rate will be adjusted periodically. And that can be done in a number of different ways. Typically what happens is they'll say, we'll lock in a rate for 2 years, let's say, and then at the end of 2 years, we'll renew the loan, but we'll give you a 20-year amortization over the 2-year period of time. So we'll create a payment based on a certain interest rate, and you'll pay that for 2 years. So you're going to pay interest and principal over a 2-year period of time, and at the end of 2 years, if everything looks good, then we'll renew the loan. We'll set a new interest rate based on what the market rate is, okay? And then we will continue on with a 15 or 18-year or 20-year amortization, okay? So they'll say, this is how the banker will say it. We'll give you a 2-year balloon with a 20-year am. And what they mean is your loan will have to be renewed. It doesn't mean that you have to pay the entire loan off. It means you're going to sit down and take a look at your payment history and how the project is coming, and if there have been any changes in your financial condition, good or bad, and then they'll look at interest rates in the marketplace, and they'll simply roll your loan over, renew your loan with a new interest rate and a new amortization schedule, which is typically a long-term amortization schedule. All right. Security dealer financing. Well, security dealers are companies that are in business to buy securities for the purpose of reselling those securities to customers. And often security dealers will borrow money, buy securities with that borrowed money, resell those securities at a profit, and pay the loan off. Okay? So this is short-term financing used by dealers to purchase securities until they are sold to customers or until the securities reach maturity. Okay? So what that means is the dealers might buy a bond yielding 8%, they might borrow money from the bank at 6%, and they make their 2% spread. Okay? Retailer and equipment financing. Okay? Dealers of automobiles, home appliances, and other durable goods extend installment contracts to enable customer purchases. So if you want to go in and buy a car, often that dealership will have a finance department. Why do they do that? Two reasons. One is to make it easy for you to buy that car. They don't want you to have to deal with the bank. Okay? So they want to help you buy the car. Why? Because they sell the car and they make gross profit margin on the car that they're selling. Secondly, okay, so the car dealer will go to the bank and borrow money, and then they'll make that money available to customers. Okay, and the dealers often charge a higher rate to customers in order to earn a spread on the loans they make to customers. Okay, so GMAC. GM Acceptance Corp. What is that? That is the financing arm of General Motors. Okay? So General Motors might borrow money from the bank at 4%, and they might charge a customer 7% on a loan. And they might be more lax. They might have easier credit checks and terms like that than a bank, and they might be able to approve your credit much more quickly. So you can go in, sit down with a GM finance guy and fill out an application in 15 minutes, show them your tax returns and your pay stub, and they may say, okay, you're approved for a 7% loan. Maybe you could have gotten that loan for 5 3/4 at the bank, okay, but it might have taken you 2 weeks. And you would have had to have given much more information, and so you just sit down and in 15 minutes they approve you, and you get your loan, and you get your car. So it's a profit center. The spread on the loans is a profit center for the dealers. Okay. All right, syndicated or participation loans, a really cool concept. And I've been involved early in my career in corporate finance. I helped banks buy into loan packages. Okay, so a loan package is extended to a corporation by a group of lenders. Okay, so this is when lenders get together. Well, let's explain it. Typically done because the loan amount or the risk is high. So if a big company goes to a bank and wants to borrow an amount of money that exceeds the bank's lending limit, rather than have the bank say no, they might go to 2 or 3 banks and say, hey, would you be willing to take, this company needs, let's say the company needs $30 million and our lending limit is $10 million. Would you be interested in taking $10 million? We'll take $10 million, we'll bring a third bank in for $10 million, and we'll make the $30 million loan, and we'll all earn a nice interest rate on it, and we'll spread the risk 10, 10, and 10, okay? And so you're spreading risk and you're making loans. And so this is a very common way that banks work together to lend, okay? Long-term project loans, okay? So this is permanent financing. Okay, and it's considered to be risky because often the terms are locked in. Here are some of the risks of project loans. First of all, they involve a lot of money. Okay, a big manufacturing company wants to build a facility. It's going to take a ton of money to build that facility. Very expensive to build a large business project. Okay, and there are factors involved. concerning the building of the project that could really slow the project down. Weather, availability of labor, availability of suppliers, steel, for example, or sheetrock, paint, okay? Then there are laws and regulations that affect a project, and if a project takes 3 years to get done, laws and regulations could change while the project is in process, and you might have to make some changes to the project, okay? Interest rates might change. Maybe interest rates go up, okay? And the bank's not going to be happy about that. They want to participate in the higher loan rates, okay? So a lot going on here with long-term project loans, okay? Then we have loans to support the acquisition of other companies. This is what's called M&A, mergers and acquisitions, okay? What's a merger? When two companies of similar size come together. What's an acquisition? When company A buys company B and company B is really no longer a separate company. So often, if there's goodwill associated or brand loyalty associated with a company that's being bought, then company A is buying company B, and they'll keep company B's name, or they'll start mixing it in with company A's name, and slowly they will use the name less and less until it's finally gone, okay? These are called leveraged buyouts because they involve the use of high levels of debt to acquire controlling interest. So this leveraged buyout is when company A wants to buy part or all of company B, and they do it by borrowing most of the money necessary to make the acquisition instead of raising capital, or instead of swapping stock. The companies will issue bonds, or they'll go to specialty finance companies or banks, and they'll borrow. They might borrow 90% of the amount necessary to make the acquisition, and they're called leveraged buyouts. And this became a real big deal back in the 80s. Okay, there we go, leveraged buyouts. All right, let's shift over to how banks assess the credit risk associated with making a loan. So often business loans involve so much capital that the entire institution may be at risk if the loan goes bad. We see that from time to time, primarily in the markets where, in the stock market, when finance companies, banks, savings and loans, insurance companies have a common stock that is traded publicly. If there is a loan that goes bad and it's a significant loan, then that information becomes public, and we see that bank stocks can get hit really hard. About a year and a half ago, Bank of the Ozarks, a very profitable, very well-managed bank, had a $20 million loan go bad, and they lost a market cap over a 1 or 2 week period of time of like $500 million. Their stock price went down to the point where, you know what market capitalization is? It is the price per share times the number of shares outstanding. So when Bank of the Ozarks announced that one of their loans had gone bad to the tune of $20 million, the stock price went down so sharply that the market cap dropped like $500 million. $500 million in a decline in market value compared to a write-off of $20 million. Okay? That is a big disproportionate response to a $20 million write-off. Why did that happen? Because the write-off, the bad loan occurred in either Florida or New York, an area that is way outside of Bank of the Ozarks' traditional Arkansas market, but it's an area where Bank of the Ozarks had been growing very rapidly for 4 or 5 years, and so investors are thinking, hey, Bank of the Ozarks is doing business in New York City, they're doing business in Miami, Florida. What do they really know? They're located in Little Rock, Arkansas. What do they really know about these areas? And we have been paying a high multiple, high PE ratio, high price to book ratio for Bank of the Ozark stock because it's been growing so much faster than other banks. But now they are having to write off a $20 million loan. Does this mean that we can expect more loan write-offs in the future? Okay, that really spooked investors. And the stock recovered, but has never gotten back to the high where it was trading before the write-off. Okay? So the survival of a bank depends on the due diligence that is done before and after loans are made. As we have discussed, banks are highly leveraged operations, which means that they rely on debt, much more so than equity. In fact, regulatory equity capital is about 11% for the typical bank. So if they have 11% in equity, what does that mean? It means they have 89% in debt. So assets minus liabilities equals 11%. Okay? So assets are only 11% higher than liabilities. If you have an 11% write-off on a loan, okay, what happens to your equity? Poof! It disappears. And if you're a bank and your equity goes below regulatory requirements, then you must raise capital. And if you're out there trying to sell stock, issue stock, at a time when you've written off loans, your stock price is going to be very depressed, and you're going to have to sell a lot more shares, which means you're going to have to sell a lot more of your company in order to stay afloat. Okay? The most common sources of repayment for business loans are the business borrower's profits or cash flow. How are loans repaid? From profit or cash flow. Okay? Assets that are pledged as collateral to back the loan. Okay? On the balance sheet, a lot of, you're looking for liquidity, and you're looking for good contributed capital by stockholders, good retained earnings. Okay? Guarantees given by the business, such as the owner's personal guarantees and property to backstop a loan. What do I mean by that? Well, if a company is a partnership or it is incorporated, then you have individuals who own the company, but the guarantees initially come from the company. If the company goes bankrupt, then the lender is out of luck. But if the lender says, we want the company to guarantee the loan, but we also want the individuals to guarantee the loan. So let's say there are 4 individuals that own a company. The company borrows $500,000, and each individual has a $500,000 house with a $200,000 mortgage. Okay? So what does that mean? They have $300,000 worth of equity in their house. Okay? The 4 individuals have $300,000 each in their homes. That's $300,000 times 4